the More Than Numbers podcast.
Hello and welcome to this edition of CK's More Than Numbers podcast. I'm thrilled to be joined today by Katy Shepherd, who is our private client partner here at CK, and Louise Axford, who is Head of Private Client at George Green Solicitors, a fellow Black Country firm. There's so much talk about trusts at the moment, particularly following the budget in October 24, and we've certainly seen a lot more work around that area. So we thought it'd be really useful to get two experts, because I'm certainly not one, to outline what trusts are, what they mean, the steps that you're going to have to take. But first and foremost, I think it'd be really useful if you could just tell us a little bit about yourselves and your background in the trust world.
Yeah, so I'm Katy Shepherd, one of the partners here at CK. I've qualified here, and after doing my professional qualification did the STEP qualification, which is the Society of Trust and Estate Practitioners. That's actually where we met, isn't it? We met while studying. And so I did that because at CK we do a lot of trust and estate work, always have done that historically, and it's really, really good to have that as part of what we can offer. So that's continued, and like you say, since October 24 we've seen more of it. We've worked together and on a lot of new trusts that are coming through now.
Yeah, so I'm Louise, I'm the Head of Private Client at George Green. Trusts have always been something that I've dealt with since I started training, really. I think it was something that we all thought might go out of fashion a little bit. Mm-hmm. So we had a lot of trusts that we were managing, but not necessarily too many new ones. But I'd say the last probably 5 or so years, we're noticing, certainly the last 2 years, a real increase in a variety of clients for a variety of reasons wanting to set up trusts, and we feel it's very important to work together as a team. So, you know, a solicitor, an accountant, and hopefully a financial advisor as well, who can all work together and be on the same page for all the clients. So yeah, hopefully we can, you know, give you an idea as to the differences and what we do.
So I suppose the first question to both of you is, what is a trust and why would you actually use or consider a trust? Because it's a word that's kind of bandied around, but people don't actually know what it means and what the implications are. So that's kind of the first step to talk about, I suppose.
Yeah, so a trust is a separate vehicle that people can settle money or assets into. It can either be in their lifetime or as part of their will and estate planning. So you either create it part of your life or it comes into play when somebody has passed away. It's like a separate vehicle, separate person that holds the assets aside from their individual assets.
So I suppose in terms of thinking about whether a trust is the right thing, you mentioned the importance of working together. That planning stage must be critical.
Yeah, and I think it's driven by the client. It's driven usually from an inheritance tax planning point of view. But it isn't just that a client comes in and says, oh, I want a trust, and we just draw one up and say, here you go. It can be quite a long process to actually get the client to say, no, this is definitely what we want to do. Because clients, it is a term that's bandied around. There's a lot on the internet, there's a lot on social media. So that's where it's important that we have those joint meetings to go through, you know, all of the tax side of things.
I think people think they're more complicated than they are. So often people go, oh, I've heard about trusts, but I don't want to do that. And so it starts
really expensive.
So we tend to start where possible. I like to start with a joint meeting with the solicitor so that you've got both sides of the picture, really. It should be part of the estate. It's no good looking at the trust on its own. It needs to be the whole picture, so that works if we can work with the solicitor. Sometimes an IFA would be involved as well. We might need them we might need another professional to do valuations. So it's not an isolated job, and it really helps when clients let you all speak together.
Yeah,
that makes a difference.
So what are the tax implications of a trust then?
So there's different stages to it, but on setting up the trust, we would look at the tax consequences. You'd look at the inheritance tax position of putting assets into the trust. That depends what the assets are, whether it's cash going in, property, and how much you can settle without creating a lifetime charge. often people don't want to pay tax to put it in, so we try to restrict it to the point where there's no tax implication of putting the assets in. There's then inheritance tax to think about in the fact that the assets, if it's a rental property, there's going to be rents coming through that will have an income tax charge, and capital gains has to be considered. So we would do that from the tax side. We'd look at the capital gains of settling. If it's cash, then it's not a problem, but if it's investments that have got a gain lying in them or property with a gain, then we'd look at that. We'd look if it's possible to do holdover relief and explain all that to the client. Whether that's possible or not, it depends on what they're trying to do really, and who's involved, if it's settler interested or where it gets a bit more complicated, but we go through that together really if we can, don't we?
Yeah, and I think that's where it depends. So the client might have come to me and said, I want to put my rental property in a trust, but they haven't considered that there might be capital gains tax, and that's where we say, well actually if Katie's involved, she can go through all of that and look at the bigger picture, and you might have assets which would be easier and more tax efficient to put in the trust rather than that rental property.
Yeah.
So I guess it's about you looking at all the different options.
And sometimes people don't think about if they put that rental property in, they're going to lose the income in their own name. The trust is going to have that income instead. So we go through all that and say, do you realise this means your income's going to drop? Are you okay with that? Can you manage that? There's lots to think about, but we can talk it through with the client.
I think that just highlights, doesn't it, how important the planning stage is. As you mentioned, it's not a simple it's not a quick process, because you've got to go through all of these different things like letter of wishes and what that means. So how would that kind of come into play?
Yeah, so I suppose once Katie's given the tax advice and the client's quite comfortable that this is what we want to do, we want to set up the trust and we want to put the rental property or the cash or the investments in the trust, I then look at, well, what are the terms of the trust going to be? And again, that can be a straightforward process if the clients are very clear, they've perhaps got a straightforward family situation, or it can obviously be more complicated if you've got a vulnerable person involved, if you've got minor children or grandchildren. So my job, I guess, is to talk them through the terms of the trust, who are going to be the trustees, what powers do you want the trustees to have, do you want them to be able to add a beneficiary to that trust in the future, do you want to keep powers as the person setting up the trust, or are you happy to give those over to the trustees? And we hope that the trust is going to last a long time, that it's not something they just set up and dissolve quickly. So we want to make sure it's flexible, that there's lots of future proofing in there. And the letter of wishes, I suppose, is the more personal document. So whilst the trust is generally quite generic and straightforward, the letter of wishes is that guidance. So it's not part of the trust, it's not legally binding, but it just guides the trustees as to what the person that set up the trust is intending them to do, and that can be changed over time. So we often end up reviewing the trust because when the person set it up, the grandchildren might be young. As they get older, their views and their wishes might change. So the letter of wishes is really important, and that's something that we spend a lot of time with the clients on, and making it as personal as possible to them and their family.
Yeah. And then what's the process in terms of once you're setting up the trust? Does it need to be registered anywhere? What are the forms that are needed?
The Revenue brought in the trust registration. That came in 2017, but for most trusts it became compulsory from 2022. We still come across trusts that aren't registered quite frequently, where people have done something a long time ago and then didn't realise. So quite often that we'll say, have you registered it? And they're like, no, so we have to look at that. So that it's quite a simple administrative process really, that. It's just going onto the revenue, logging it, putting in the details of who the main parties are, the settler, the beneficiaries, trustees. But it's important it's updated. The revenue want that to be accurate and updated. So again, as well as saying we have a trust being registered, as it goes on we say, have you updated it each year? Part of the tax return now is to say yes, we've been on and updated the trust register. So we would tend to do that, but you do as well. So
we have clients where, particularly if there's no ongoing tax being paid, so if it's just a property that's in the trust where someone is living and not paying rent, we can register that trust for them. But I think certainly if it's a trust where we've both been involved in the setting up and there's going to be ongoing tax, then it makes sense for you to do the registration. And some clients can do that themselves, but we find that they often get into difficulty and want you to do it.
So we have those sitting under our agent account is how that works. We've got the trust register as part of CK as an agent, and we log in and make the changes.
So obviously once you've set up that trust, you've got the lifetime of the trust, the day-to-day kind of running of that trust and choosing those trustees. So they really need to understand what their role is as well. It's critical, isn't it?
Yeah, and I think that's where we find that if Katie or the accountant is involved in doing the tax returns, that's an opportunity for the trustees to at least think about the trust and speak about the trust, and that's where often other things will crop up in conversation, and then it ends up potentially coming back to me if they need to change the trustees or change the beneficiaries, or they're thinking about assets leaving the trust. So we always think it's actually really helpful from that point of view to have that accountant involved, because
what we're doing with the compliance work is looking at it at least every year, if not more frequently. So we're probably a bit more hands-on the day-to-day than a solicitor would be, but then we'd have conversations with the trustees or the beneficiaries, which then might lead to them saying, "Oh,
we need to think about this." And Louise gets
we had one recently where a man was a trustee, he's now lost capacity or losing capacity. We spoke to the daughter and said, you need to consider the trust as well. So then we would go back to a solicitor and say, we need a deed and that.
And it's things like that where if you hadn't have been involved, potentially that situation, if he's then lost capacity, that could be more difficult, especially if he's also a beneficiary of the trust. We might need to get involved with the Court of Protection. So again, I think it's just useful that the trustees have got that contact every year to review what's happening.
And I suppose there's also the general admin of a trust, particularly if there's income, there's that banking element and all of those things to consider.
Yeah. Which is what us as a firm here, we do a lot of that. We're quite unusual in that sense that we will pick up all the administration, we'll help set up bank accounts, like run the cash book, reconcile the bank, get the bank statements come through here, and the investment manager reports and all that, and we do all that here. And then if the trustees want it, we'd go on to produce the annual trust accounts, which not every trust needs trust accounts, but it really depends on how many beneficiaries involved and if they want to be able to see that it's been shared fairly or that there's income waiting to be paid out. And so we can do that along with the annual tax returns, assuming the trust has got income and gains that need, or income or gains that need to be reported. We would do the tax return each year, and the trust registration then has an annual declaration that we complete as well.
Okay. And then we spoke briefly about those kind of points at which you would need to get involved. You mentioned about deeds for changing trustees or bringing on new ones. Any other sort of moments in a trust's life that you would get back involved with?
I suppose it's if the family dynamics change. So if the trustees have got together or spoken to Katie perhaps about one of the beneficiaries needing something extra from the trust, so appointing assets out to them, or potentially updating the letter of wishes if their views on the trust have significantly changed. What sometimes happens is, a trust might have been set up for all the children, and then maybe one has their share and the other two continue to hold it within the trust. So we might then look at removing that beneficiary who's had their share, again updating the letter of wishes. So and sometimes we don't necessarily end up producing any documents. It's more just us having a conversation with the trustees and making sure they're happy with everything. Because we've got trusts that have been ongoing since the 1980s. And obviously things have changed, and if the tax legislation changes, again we might review whether the trust is still the right thing. So, and it's good to keep in touch with the clients. It's the bit of the job we like.
Yeah,
so.
Absolutely.
Yeah.
So I suppose we've got through the lifetime of the trust. How and why and when would you end a trust?
Well, I suppose if the tax rules have changed, where actually it made the trust no longer tax efficient, or there was sort of quite hefty ongoing tax or costs that were being paid, where we actually felt, look, I'm not sure this trust is really giving you the benefit that we thought. Or if, you know, for example, if it was set up for the grandchildren and they're all in their late 20s, 30s and they're quite...
It tends to be kind of life events that trigger people to consider whether the trust is still the right thing. So like it might be like you say, grandchildren, they've all gone through university and they're at points of getting married or buying houses, and then they'll say, well, we'd like some money out. There's a bit of a balance as to whether it's worth keeping it for just one or two beneficiaries, so we'd review it then. I suppose we would look at it from the figures and the value point of view, and then Louise would come in with, actually, does the deed allow us to get the money out now, or do they need to be a certain age? Sometimes the deed will restrict.
And that was going to be one of my next questions, actually. So how do you actually get money out of a trust? Because once it's in there, that's fine. We've spoken about putting things in there, but how do you actually get things out?
Well, there's a tax consequence. So it's not as simple as I just want that and pay it out. So we would look at the tax again. We'd look at from an inheritance tax point of view. It's what's called an exit charge for inheritance tax. So we would calculate that, give the people an estimate of what the tax was going to be, and then they have to weigh that up as to whether
it's worth it or not.
They want to pay that compared to leaving it in the trust. That really depends on the rest of their wealth and whether the trust is still good for them because of whatever else they own. So we'd look at that. Capital gains is an issue. It can be an issue again if it's investments and they've risen in value, there'll be a gain. But again, there's holdover, the same way as there's holdover claim is normally possible when you put something into trust. You can look at holdover for taking it out. So it knocks it down the line, sort of defers the tax charge for when the beneficiary themselves looks to sell that asset. So we can advise on all of that, assuming they then go, yes, we want the money out, we want the asset out. We'd go to Louise to say we need a deed.
And that's something that I think a lot of trustees don't realise, that we'll just, give the cash or transfer the property out, but the terms of the trust deed will usually say it has to be done by way of a deed. So again, it's just a paper trail, so there's just a document to say that the trustees are transferring that asset or that cash out of the trust to ABC beneficiaries. And I think sometimes that's where we will make sure that, whilst it's possibly beneficial from a tax point of view, are they comfortable that this person is now going to have that asset or that money in their own name? Is that what the letter of wishes intended? Is that beneficiary trustworthy or of an age where they're going to be able to cope with whatever it is?
And whether anyone's influencing that decision sometimes, like if you feel like the family dynamics are a bit that one's being pushed by another, within reason we do what we can to make sure everybody was being treated fairly.
So, I mean, absolutely fascinating. Just to conclude on trusts, I suppose, why would you say somebody should consider a trust? It may not necessarily end up being the right thing for them, but why should they consider a trust?
Well, I think if a client is concerned about inheritance tax, which obviously a lot of clients are, then a trust is a good option where you want to start that 7-year clock, give some assets away, but perhaps the beneficiaries aren't in a position to receive those assets just yet. So it offers a lot more flexibility, a lot more protection if you are concerned about those assets being in the hands of individual people. So it's an opportunity to start that clock without fully giving away control of those assets, and particularly if it's a family business or a farm, where obviously there are significant tax changes now. It allows you to give those assets away, but stay in control as trustee and a shareholder. Which
the main change that was the October 24 budget was the fact that everybody's got the allowance for BPR. It's not unrestricted, so the trust has got its own allowance, which is why they seem to have come back a lot lately.
And I think clients, particularly if perhaps they're in their 50s or 60s. Because you can only give so much away every 7 years, they're starting to think about it a bit earlier than perhaps they otherwise would. And at that point, their children and grandchildren may only be very young. So it's an opportunity to reduce your tax bill, but stay in control and keep that flexibility for the future.
Yeah, that's brilliant. Well, thank you so much, both of you, for giving us what seems like a whistle-stop tour of Trusts.
Yeah.
So I think the key message is it is an option, but it's something to think seriously about and get the likes of Katy and Louise involved in those early discussions so you're aware of all of the facts, all of the implications of trust. So lots of food for thought. Thank you both so much.
Thank you.
And we look forward to seeing you on the next episode of More Than Numbers.
The More Than Numbers podcast.